Okay, let's unpack this. Today, we are not just, skimming financial headlines. We're doing a true deep dive into a really unique stack of documents.
Mm-hmm.
This is not public research. We're talking about highly specific proprietary market analysis.
That's right.
And our mission here is to take you straight into the engine room of strategic thinking. We're going to break down the methodology, the conclusions, everything in these LoopMarket documents.
And that's a key point. For you, our listener, this material is owned by D Investment Enterprise, LLC. It's published by D Publishing Group.
Okay.
And the analysis itself, the one we're digging into, was authored by Devin McClarty, who is the founder of Structural Intelligence.
So when we say LoopMarket, we're actually talking about the outputs from these licensed systems.
Yeah.
Things like LoopSpeak and the financial engine.
Exactly.
So before we get into the analysis itself, help the listener understand, what are these systems? LoopSpeak, the financial engine. What kind of analysis are we really dealing with here?
That is a crucial distinction to make. These are not just newsletters. Structural intelligence uses these systems to generate market insights through quantitative flow-based analysis.
It's all based.
Yes. Think of the financial engine as the proprietary math model. It's what interprets all the complex market correlations.
I see.
And then LoopSpeak is kind of the communication layer on top of that. It translates this really complex movements into the specific language you'll hear us use today.
So terms like rotational map or sentiment fragile.
Precisely. They're providing a systematic proprietary view of capital flows and sentiment that you don't see in standard economic models.
Perfect. So we are looking at a very specific X-ray of the market.
Mm-hmm.
And the period we're focused on for this analysis is the week of November 17th to 21st, 2025.
Right. And the core thesis that McClarty's analysis puts forward for that 5-day period is honestly the most important thing you need to know right off the bat.
And that is?
That it was a policy-dependent, rotation-driven, sentiment-fragile week.
That is a stunningly concise summary. I mean, the source material claims that fundamentals stepped aside and the Federal Reserve took full control of price discovery.
Full control.
That suggests, an almost total subjugation of traditional metrics, like corporate health to central bank signals. My question is, was this level of policy dependence really unique to this 1 week? Or was the volatility just making a long-standing trend more visible?
The analysis argues it was visible to an extreme degree. And what's truly fascinating is how the source material structures the narrative of the week. It calls the events a distinct two-act play.
A two-act play. I like that. It gives it a sort of market drama feel.
It does. It gives portfolio managers a really clear story to follow.
So a drama where the central bank is the Dios's ex machina. Let's hear about Act 1.
Okay, Act 1 was the initial decline. The documents say the markets bled lower. This was driven by two things. First, you had some weak economic data creating a general risk-off mood. But more crucially, the sources point to very sector-specific fears. They actually cite NVIDIA-driven fears that kicked off some significant capital outflows and tech rotation.
So not a gentle correction.
No, this was a structural concern setting in.
So the market was reacting to weak data, and this fear that its primary growth engine, AI tech, was maybe running out of steam at its current valuations. That's a powerful cocktail for a decline.
A very powerful cocktail.
How quickly did Act 2 show up?
Well, it arrived abruptly. And that really highlights the sentiment fragile part of the thesis. That sharp downward trend was instantly halted and then completely reversed.
What caused the reversal?
Unexpected dovish Fed commentary.
Yeah.
And the implication of that reversal is just. It's profound. The underlying economic weakness, the valuation fears that drove the first few days of trading, they were instantly rendered secondary.
So all that mattered was the prospect of supportive policy.
That's it. All that mattered was the Fed.
It sounds like a market just running on policy adrenaline. If policy expectations are the main catalyst and they're overriding fundamental reality, it really confirms the return of that counterintuitive mindset.
The bad news is good news paradigm. Absolutely. Negative economic data gets immediately interpreted as positive for traders.
Because it means the Fed is more likely to step in.
Exactly. It increases the likelihood that they'll be forced to ease monetary conditions, which, at the end of the day, supports asset prices. The severity of that reversal just shows you how deeply ingrained that response is now.
We should probably anchor this policy whiplash in the numbers. Let's look at the quantitative proof. The net weekly results, even with that strong rally on Friday, showed just how much ground was lost in Act 1.
Oh, the divergence in the indices speaks volumes about the fragility and the rotation. So for the week of November 17th to 21st, the S&P 500, the SPX, it closed down a net 1.6%.
Which is a painful week.
It is, but you have to remember, it took a massive 1.0% rally on Friday just to get it back to that level.
And looking at the tech-heavy NASDAQ Q, the pressure was much, much worse. That tells you immediately where capital was flowing out.
It tells the whole story. The Nasdaq closed the week down a full 2.5%. And that's even after it also got that Friday surge of plus 0.9%.
Wow.
That rally, which was driven by those dovish policy expectations, it just wasn't enough to offset the structural selling from earlier in the week. The rotational damage is already done.
And what about the fixed income market? That's usually the first place to price in policy shifts.
It confirmed the whole theme. The 10-year Treasury yield fell significantly. It dropped from 4.14% down to 4.06%.
Okay, that's a big move.
It is. That downward move in yields is tangible proof that the bond market was aggressively pricing in those dovish signals from the Fed. It saw the writing on the wall faster than equities could react.
So the drop in the 10-year really validates the entire thesis of policy control. But the biggest quantitative insight, as the analysis implies, is that NASDAQ Q underperformance. That naggis 2.5% isn't just a loss, it's a signpost.
It's a huge signpost. It points directly to the magnitude of the sector rotation, which is the rotation-driven characteristic of the week.
Right.
When you see that level of divergence between the broad market, like the SPX, and the growth-heavy segment, like NASDAQ Q, capital didn't just exit the market, it was looking for a new home.
Which leads us directly to the rotational map.
Exactly.
So let's follow that money. The LoopMarket analysis defines this map as the critical indicator of how investors were repositioning.
Yeah.
So where was the primary source of the outflow?
Well, it's not a huge surprise. Information technology. That sector was the identified primary source of outflows.
And the reason?
It was fueled by concerns that the source material labels as valuation fatigue in AI tech.
Valuation fatigue. Let's dig into that NVIDIA-driven fear element. It wasn't just profit-taking. That phrase implies a more structural worry.
It does. The analysis suggests the market suddenly realized that the forward growth expectations for AI might be, fully priced in.
Or worse.
Or worse, that they were vulnerable to a slowdown if the broader economy really weakened. When policy uncertainty is high, investors get extremely risk-averse about companies that rely on those high multiple growth stories.
So the minute the market saw weakening data in Act 1, the risk-reward calculation for the highest flying tech stocks just flipped negative.
Flipped negative very, very quickly. And that capital had to go somewhere fast.
Okay, so if tech was the outflow, the capital flowed into two distinct strategies. It reflects a split investor mindset, right? One part speculative, one part defensive.
That's a great way to put it.
Let's tackle the speculative, policy-driven destination first.
That was the rate-sensitive rotation. Capital flooded into real estate and home builders. And this wasn't a bet on improving fundamentals in housing.
No, this was a pure bet on the central bank pivot.
A purely strategic wager. They're betting that the dovish commentary from Act 2 will translate into tangible benefits for these industries.
Lower mortgage rates, cheaper construction financing, things like that.
Precisely. The market is positioning itself ahead of the policy outcome. It's showing a forward-looking confidence that the Fed's stance signaled a rate peak or maybe even future cuts.
Okay, and then you have the second strategy, which is the classic de-risking move. Where did the really conservative money run for shelter?
That capital went to the defensive anchors. Healthcare and utilities.
The classic safe havens.
Exactly. These sectors represent a search for stability, for reliable, non-cyclical earnings streams. In a week like this, investors sought refuge in businesses where demand stays relatively constant, regardless of interest rates or the broader economy.
So it's a clear flight to safety.
A very clear flight to safety. It indicates a broader de-risking move by cautious managers who just wanted to hedge against all that uncertainty.
So funds moved aggressively out of high-growth risk and into two distinct havens, one banking on the future policy environment,
The rate-sensitive bet.
and the other banking on current economic stability.
The defensive bet. The LoopMarket analysis just maps out the mechanics of that fear and dependence perfectly.
Okay, so if we synthesize all of that, the two-act play, the NASDAQ Q underperformance, the capital flows, what are the big takeaways? What's the so what from Devin McClarty's documents?
The documents provide 4 major macroeconomic conclusions. They really define the new investing landscape.
Let's run through them. What's number one?
Conclusion 1 is the return of the Fed put. That sharp, abrupt reversal confirms a renewed and, frankly, powerful belief that the Fed will actively intervene to stop big asset price declines.
So it's not a question anymore, it's an assumption.
It is a foundational assumed premise now guiding institutional capital.
Okay. And conclusion 2 gets back to the structural problem from Act 1.
That's right. It's valuation fatigue in AI technology. The sustained rotation out of tech, specifically citing those NVIDIA-driven fears, is compelling evidence that investors are now actively questioning the sustainability of valuations in the AI space.
The market is getting intolerant of risk premiums based only on future promise.
Exactly. Which leads into conclusion 3, which is about the shift in risk appetite.
The move into defensive assets.
Yep. They call this liquidity withdrawal. That shift from tech to lower-risk sectors suggests a broader liquidity withdrawal from high-risk assets overall. It just indicates a systemic, cautious, defensive investor posture.
A preference for preservation over speculation.
Well said.
And finally, the conclusion that ties the whole narrative together.
Conclusion 4 reconfirms the bad news is good news paradigm. Traders are not primarily concerned with the actual fundamental impact of weak economic data anymore.
They're just focused on what it means for policy.
They prioritize the policy implications, the chance of looser money over the economic reality itself. Policy is the lens through which all data is now viewed.
This proprietary analysis gives us such a detailed look. It's a clear case study of how market psychology and capital flows are just. They're entirely policy dependent now. This deep dive really underscores that the market is a mechanism for pricing central bank communication more than pure economic health.
It really does. And the analysis concludes with this proprietary statement from what they call the LoopMarket closing lens. It offers a sort of philosophical perspective on this central theme of dependence.
I'm curious.
It's very concise, but it's incredibly insightful for you, the learner. It says, gold measures fear. The dinar measures faith. The dollar measures dependence.
Wow, that is a powerful framework.
Isn't it?
Gold is the hedge against fear. That's classic. The dinar, or any currency really pegged to national stability, that measures a kind of faith in an economic structure. But the dollar measures dependence. It reframes its role not just as a reserve currency, but as a proxy for the entire market's reliance on central bank signaling.
Exactly. It raises a pretty profound question for you, the learner.
Oh, kiss.
If the U.S. dollar and the major asset markets we all track are currently being priced through this metric of policy dependence, how far does that reliance on the Fed extend into your own financial decision-making?
That's a great question. You have to take a moment and really consider. Is your current investment strategy based on what you believe about true fundamental economic reality?
Right. Or are you implicitly relying on the assumption that the central bank will always step in?
That they'll always be there to prevent a major decline. The insight from these LoopMarket documents is pretty clear. Dependence is the dominant metric of market behavior right now.
It certainly is.
Definitely something to mull over as you build your strategy until our next deep dive.